Imagine a nation that rose faster than any empire in modern history and is now slamming into limits it can no longer outrun. A real estate sector that once made up a quarter of the economy is cracking. A population shrinking faster than any major nation ever recorded, and debt piling up so quickly that some statistics quietly disappear from official reports. And underneath all of it is a slow-burn structural pressure that does not arrive with a single crash. It arrives as decades of stagnation. This is the real story behind China's 5% growth headline. Not the version crafted for investors, but the one buried in demographic tables, debt charts, and capital flows. Today, we're going to expose the dark economics behind the world's second-largest economy and the forces reshaping its future in ways the world can no longer ignore. China built the fastest urbanization project in human history. Entire megacities rose in a single decade, and high-speed rail stitched together regions that barely existed 20 years ago. It was a construction miracle, and it was built on borrowed time. When Evergrande finally collapsed in 2024, it wasn't just a corporate failure. It was the liquidation of more than $300 billion in liabilities, the largest real estate implosion the world had ever seen. By August, the company was delisted from Hong Kong's exchange after 18 months of frozen trading. Country Garden followed. Once the golden child of private developers, it posted tens of billions in losses and agreed to a restructuring that gave creditors just 22 cents on the dollar. This wasn't a healthy correction. It was the breaking of a system built on a single assumption. Property prices only move in one direction. In Shenzhen, home prices hit 43 times the median income. Beijing and Shanghai weren't far behind, almost double London and Singapore, and triple New York or Tokyo. For Chinese households, buying a home wasn't an investment. It was a life sentence of leverage. Then Beijing tightened the screws. The 3 red lines policy, meant to curb reckless borrowing, cut off credit at the very moment developers needed it most. Projects stalled mid-construction. Buyers who had already paid deposits watched empty concrete shells gather dust, and confidence evaporated. Property still made up 19% of China's GDP in 2024, down from a peak of 24%, but still larger than the entire economy of South Korea. And when a sector that big deflates, it doesn't bounce back in a year. It drags. It reshapes the whole growth model. Officials insist the market has bottomed. They've rolled out whitelists, approved trillions in loans for safe projects. But buyers aren't returning. Developers are still defaulting. Local governments are starving for land sale revenue. The property boom didn't just build cities, it built household wealth. And now, a large part of that wealth is evaporating. The most powerful economic force in the world is not technology, or capital, or even innovation. It is population. And China is losing it faster than any major country in modern history. In 2024, China's population fell to about 1.408 billion, a drop of nearly 1.4 million people. It was the 3rd straight year of decline. Births have collapsed, from around 20 million a year in the early 2000s to roughly 9 million today. The fertility rate is near 1.0, roughly half the replacement level, and one of the lowest on Earth. But the real crisis isn't just fewer births, it's the speed of aging. More than 310 million Chinese are already over 60. By 2050, the old age dependency ratio will more than double, from about 0.21 to 0.52. In simple terms, every working age adult will need to support more than twice as many retirees as today. United Nations projections suggest China could lose more than 200 million people by the mid-2050s, and fall to roughly 633 million by the end of the century. That is not a dip. It is a redesign of the country. Beijing has already abolished the one-child policy, introduced birth subsidies, childcare support, extended parental leave. None of it is reversing the trend. The Yuhua Population Research Institute ranks China among the most expensive places on Earth to raise a child. Housing is punishing. Education is an arms race. Cultural expectations that children must support their parents financially add yet another layer of pressure. In 2024, only 6.1 million couples married, down from 7.7 million the year before. Young Chinese are not rejecting marriage because of rules. They are rejecting it because the math does not work. An economy can print money, it can build infrastructure, it can stimulate demand, but it cannot print workers. And once demographics turn against you, they do not turn back within a single lifetime. China's demographic decline is locked in for decades. No stimulus package can change that. On paper, China's government debt looks manageable. Official gross debt is around 88% of GDP, lower than the United States or Japan. But that is only the visible part. When you include the borrowing hidden in local government financing vehicles, the IMF estimates the true public debt load at roughly 124% of GDP. Ratings agencies believe local governments may be hiding another 40 trillion yuan off the books. Zoom out further, and total non-financial debt hits about 312% of GDP, up sharply in just a few years. That puts China in the same league as the most indebted advanced economies on Earth, despite income levels that are still firmly middle income. State-owned firms alone owe the equivalent of 74% of GDP. Policy banks owe another 29%. Chinese households, whose wages have not kept up with living costs, now carry debt equal to over 60% of GDP, triple their leverage in 2008. Here is the core problem. Local governments borrowed heavily to fund infrastructure, new districts, vanity projects. They paid for it by selling land to developers, who then sold apartments to households. As long as property prices rose, as long as land sales flowed, the machine kept running. But when the property market slowed, the entire financing model broke. Land revenues collapsed, local budgets shrank, the debt stayed. Beijing is now issuing special bonds to help local governments refinance. The central bank has promised a looser stance, but every bailout, every rescue program, every new credit push adds to the total stock of debt. China is not Greece. Its debt is in its own currency, held mostly at home, and backed by a powerful state. But that does not make it free. It just means the reckoning looks different. Less like a sudden default, and more like a long grind of lower growth, diminishing returns, where each new unit of debt buys less and less real output. That is what a debt trap looks like. Not dramatic, just relentless. China officially reported 5% GDP growth in 2024. The target was met. The headlines were optimistic. Independent researchers see something else. Groups like Rhodium estimate actual growth closer to the mid-2% range. The gap comes from what the official numbers smooth over: weak consumption, fragile confidence, and a youth unemployment crisis serious enough that the government stopped publishing the statistic for a time. Retail sales grew only 3.5% in 2024. That is not what you expect from an economy shifting to a consumer-driven model. Households are cautious because they're watching property values fall, job prospects wobble, and long-term security erode. Youth unemployment officially climbed above 21% in mid-2023. Then the entire data series disappeared. When it came back with a new methodology, the number had dropped on paper. But independent estimates suggest the underlying reality did not improve nearly as much. Manufacturing and high-tech exports posted strong numbers, but even there, new headwinds are forming. The United States and European Union openly accuse China of industrial overcapacity and are responding with tariffs, export controls, and investment restrictions. The real danger is not a single bad year. It is the feedback loop. When households feel exposed, they save more and spend less. When they spend less, businesses cut investment. When businesses invest less, hiring slows, and wages stagnate. And that makes households even more cautious. Japan followed that exact pattern into its lost decades. It did not begin with a crash. It began with a slow drift into a low-growth equilibrium that became almost impossible to escape. Over the last decade, China has made a clear choice. More centralized control. Term limits were removed. Power was consolidated. High-profile entrepreneurs were fined, sidelined, or quietly disappeared from public life. Tech giants saw sudden crackdowns that wiped out hundreds of billions in market value. Entire industries, private tutoring, online finance, were shut down or heavily restricted in a matter of months. The message is simple. Political stability and loyalty to the party come before economic efficiency. From the party's perspective, this is rational. The collapse of the Soviet Union is the ultimate cautionary tale. Lose control, lose the system. But there is an economic cost. Foreign direct investment, once one of China's greatest strengths, has fallen sharply, even turning negative. Multinationals are shifting production to Vietnam, India, Mexico. Domestic elites are moving capital abroad, buying homes in Vancouver, Sydney, Los Angeles, securing foreign passports. Innovation slows in this environment. When entrepreneurs aren't sure whether success will be rewarded or punished, they take fewer risks. When rules can change overnight, distributed, firms grow cautious. When data and information flows are tightly controlled, the pace of technological progress drops. A system optimized for control can stay stable for a long time. But stability and dynamism are not the same thing. And right now, China is clearly prioritizing one over the other. Among young Chinese, a quiet rebellion has taken shape. Tangping, lying flat. It does not look like traditional protest. There are no marches, no slogans. Just people doing the bare minimum, refusing to grind for careers and lifestyles they no longer believe are attainable. Housing is out of reach. Education is a brutal tournament. Corporate culture expects 9 a.m. to 9 p.m. 6 days a week, with no guarantee of upward mobility. Faced with that equation, many young people are stepping back. Marriage is delayed or abandoned entirely. Weddings fell by more than a fifth in a single year. Births continue to drop. Ambition is redirected towards safer, more predictable government jobs, or toward minimalism. Japan saw a similar pattern in the 1990s. Its herbivore men, a generation that quietly turned away from traditional markers of success. It coincided with long-term stagnation. No economy, no matter how large or sophisticated, can sustain high growth if its next generation quietly gives up on the game. The comparison between China today and Japan in the early 1990s is hard to ignore. Both faced huge property bubbles, rapidly aging populations, rising debts, slowing productivity. But there is one crucial difference. Japan hit its wall after it became rich. By the time its bubble burst, it was already a high-income country, with world-class living standards. China is hitting its slowdown while it is still climbing. The average Chinese citizen earns a fraction of what the average American, European, or Japanese citizen earns. Large parts of the country remain firmly middle income. Economists call this the middle income trap. Fast growth from copying and building is relatively easy. Fast growth from innovating and optimizing is much harder. China's total factor productivity, its measure of innovation and efficiency, grew around 3.7% a year in the 2000s. In the 2010s, that fell to roughly 1.9%. And it has slowed further since. You can build cities with debt and cheap labor, but you cannot build the next generation of technology the same way. That requires openness, experimentation, and a tolerance for failure and dissent. And all of those sit uneasily with increasing political control. China is trying to become one of the few nations to break out of the middle income trap, while carrying more debt, with fewer young workers and under tighter political constraints than the success stories that came before it. For 2025, Beijing's answer is clear: more support. The budget deficit is being raised. Local governments are being allowed to issue more special bonds. The central bank has signaled a moderately loose stance, language it has avoided for more than a decade. This may work in the short term. It can prop up growth, prevent a sudden shock, and buy time. But it does not fix the structural problems. China still needs deep fiscal reform, so local governments are not addicted to land sales. It needs a stronger social safety net, so households aren't forced to hoard cash for retirement and medical bills. It needs a predictable environment for private business, so capital flows toward productivity instead of political favor. It needs modern hukou reform, so labor can move to where it is needed. And it needs serious, expensive support for families if it wants more children. The question is not whether China can hit 5% growth for another year with enough stimulus. The question is whether it can redesign its model while the demographic clock is ticking and the debt meter keeps rising. China is not just another large economy. It is the central pillar of global manufacturing, the largest trading partner for more than 150 countries, and a major driver of world growth. If China slows meaningfully, the world will feel it. Commodity exporters that rode China's construction boom will see weaker demand. Emerging markets that borrowed heavily from China and tied their fortunes to its investment will face harder choices. Supply chains built around China as factory of the world will keep shifting to new hubs, but the transition will be messy and uneven. Financial markets will not be immune. Even with capital controls, China's weight in commodities, corporate profits, and investor psychology is too large to ignore. If investors begin to price in permanently slower Chinese growth, global risk appetite will adjust. And economic stress rarely stays purely economic. A China under pressure at home may become more assertive abroad, more nationalistic, or more inward-looking. Any of those paths would reshape geopolitics. Every great power that hit structural limits before China, from Britain to the Soviet Union to Japan, sent shockwaves through the world when its growth model broke. China's economy is larger than all of them. The ripples this time will be waves. China is not on the brink of sudden collapse. The doomsday predictions are almost certainly wrong. But the story of unstoppable ascent is wrong too. What is really happening is transformation. A population shrinking and aging faster than almost any in history. A property sector that powered 2 decades of growth and is now unwinding. Debt levels that quietly limit what policy can do. Productivity growth stalling, just as innovation becomes essential. A generation of young people stepping back from the old promises. And a world no longer willing to give China the same open access it once enjoyed. China still has strengths: a huge domestic market, world-class manufacturing, large foreign exchange reserves, strong infrastructure, and a government that can move quickly when it chooses to. But strengths do not erase constraints. They only give you room to manage them. The next phase of China's story will not look like the last 40 years. Growth will be slower. Adjustment will be painful. Some sectors will adapt, others will decay. And the rest of the world will have to recalibrate around a China that is no longer pure opportunity, and not yet in crisis, but stuck in a difficult in-between. Understanding that reality matters, because China's transformation is not just China's story. It is one of the stories that will define the 21st century. If you want more deep dives into the dark economics that are quietly reshaping this century, make sure you like this video, subscribe, and turn on notifications. Most people only see the headlines. Here, we read the numbers that come after them. The forces that will define the next 20 years are already in motion. The question is whether you see them in time.